I typically, in my videos and in my articles, refer to two preferred measures of sentiment. From the just global capital market perspective, I like the S&P 500. This represents a lot of things, and there are a lot of other substitutes you can use, such as global equities, any global equity index really. But I like the S&P 500 given where it's at, the persistence and the debate and certainty that has come from moral hazard, as well as the leverage that reflects that certainty. There's a lot in this that would actually present a very good measure of risk on. All right. And on the opposite end of this spectrum, I also look at the US dollar. This is a interesting measure because it has had a remarkably positive correlation to the risk-on factor, the S&P 500, which is quite unusual because we would expect that it performs terribly during a risk-on theme. And I think that that relationship, or that unusual relationship, is a reflection of the kind of conditions that we are actually confronting right now. All right. But this is, if we did see a massive unwinding of risk, would be a fantastic place to see a very severe rally. The US dollar taking back up its role as a ultimate safe haven asset. All right. Now I want to look a little bit more closely at this about why these relationships exist. More importantly, and a very common question I'm getting, how can I establish, how can I confirm that risk on or risk off is truly in charge of these markets, particularly risk aversion? Because we have had a number of false starts, including this most recent one through the end of January and into the beginning of February. All right. It was certainly a very strong, very powerful risk aversion move, and you had a lot of momentum behind it, but it dried up relatively quickly. How can I separate the false starts like that from the true conviction? All right. Well, the first thing that we often look at is the market's expectations. All right. This is the S&P 500 versus the VIX, or volatility index. There are volatility indexes actually for the entire market. All right, or all market assets. They're just sometimes difficult to find. A lot of people have actually been recently asking me about the volatility index that I have for the FX market, which I created my own. And it's derived from options, a number of majors, so it's actually complicated or very difficult to reproduce. But you can substitute, in many instances, the average true range. Right? This is a fantastic measure of actual activity in the market. It will deviate sometimes substantially from the VIX, or expected volatility index, but it is a very good substitute under most circumstances. And this is true of the S&P 500, or sorry, the Dow as well. You can see just how quiet that measure is. This is actually a fantastic correlation, this ATR to the FX volatility index. Okay. So why do these volatility indexes stand as good measures of risk? Right, just like the ATR, an increase in activity. It doesn't have to be up or down, but the increase in activity is a good reflection of volatility. Right, the markets are just generally more active. But these measures, the volatility indexes, the VIX that we actually have, these are derived from, and there's a number of reasons that these stand as good measures of risk, but they are, one, option-based. The implied volatility is backed out of the price of options, and those products are oftentimes used as a hedge. There's also a bullish bias to many of these benchmarks, including the S&P 500. All right, and in reality, it's that there is a bias in terms of the markets are move more aggressive to the downside, whatever that might be. So unwinding of risky positions occurs much more quickly and much more destructively than a risk-on or greed buildup. All right, so we end up having a fantastic negative correlation to risky-based indexes like this and volatility reports or volatility indexes. That's why when we flip this upside down, the relationship is so strong. All right, so we look at these volatility indexes. You know that you can use the ATR as a substitute, particularly in the FX market. So what do we, or how do we measure the severity of risk trends? Right. Well, of course, if the ATR really picks up, if the VIX indicator truly picks up, you do have a strong risk aversion theme. But how do we avoid seeing false starts like this? Well, the next level up to measuring this is to looking across the various asset classes. All right, something that we talk about every now and then is that there are many different asset classes that move based on numerous different factors. There are millions of factors that go into pricing, let's say the stock market or an exchange rate or the US dollar individually. All right, there are so many things that go into pricing it in. What we see, however, is that when these various assets, let's say equities and FX and commodities and treasuries and high yield assets, emerging markets, when all those assets are moving under the same precedence, under the same fundamental drive, that's when we know that that fundamental category, that fundamental theme is extremely important. And if it's risk trends, that's when we know that risk trends are exceptionally market moving and have a lot of not just breadth, but also depth. And that means it's more likely to continue. All right. So here we're looking at the S&P 500 versus the emerging markets. This is the MSCI Emerging Market ETF. Now, this is a positive to negative correlation. When we get up to 1, that means it's an extremely strong positive correlation. They move together in tandem most of the time, almost in lockstep when we get up to 1. And if it gets down to -1, which it hardly ever gets below into the negative territory, that means that they are moving exactly in opposite directions. Rarely happens. Right? And when it's at 0, they have no relationship. They don't seem to be moving in any kind of set order. So when we see this relationship, this is based on a 20-day moving correlation or rolling correlation, you can see that the S&P 500 and emerging markets are actually very highly correlated most of the time. So what does this say? This says that the S&P 500 and emerging market index, this is not something that you would say, all right, well, the S&P 500 is dropping, the emerging market index is dropping. This must be a super strong risk aversion signal. It doesn't necessarily reflect that because, as you can see here, these two move in tandem most of the time. Now we can look at something very different, however. Now, as I said when we were looking at the dollar has started to show a positive correlation to the S&P 500, which is unusual given its circumstances as a safe haven. That's because safe haven, the risk aversion theme, hasn't really gotten very strong. Now you can see that when there's a positive correlation, the two move in tandem, which is unusual historically speaking because the dollar is a safe haven. And when it's strong negative, they move in opposite directions. And that is a good sign that you have risk on or risk off. It can be either or as long as they're moving in opposite directions. Now, obviously, this has oscillated a lot given this 20-day rolling correlation. So I just wanted to highlight the periods here for you when you have a strong negative correlation, and that is indicative of markets moving under a sentiment theme. All right? You can see that this is far more rare. All right? And we have not, in this particular move, seen a strong relationship. Now, the concept of seeing multiple markets moving under the same theme, risk trends, and using that as a gauge of strong risk on or strong risk off can be applied to not just the price action, but the volatility measures as well. We can use those volatility measures and across the board. So what I did was I pulled up all the volatility measures for these various asset classes, equities, gold, oil, treasury, emerging market, and FX, and this is what they've done since the beginning of the year. We had that very tremendous pickup in volatility for the equity market, but it never really got to that level of pickup in the other asset classes. In fact, something like gold has seen a substantial collapse in volatility. Now we go all the way back to the beginning of 2013, and you can see that this activity level is still exceptionally low, and this was just a recent increase in volatility. However, the relationship between these indexes showed that, yes, volatility was rising in tandem, so risk aversion was certainly there. The only problem is it did not necessarily get that severe. All right? Severity in both the relationship as well as the increase in actual volatility itself. Now, when I'm measuring volatility and its commitment and how strong it is, I like to look at very certain indexes here, volatility indexes here, and that is the equity, the treasury, the emerging market, and FX volatility indicators, because these are the more yield sensitive, the more risk sensitive, and they will certainly be more restrained and wait until there is a definitive move. All right? Equities have proven exceptionally restrained when historically they haven't really been, and this is where their value comes in. When these four volatility measures all rise, and all rise in tandem, that's when we know we have a strong risk theme. And when all the markets are aligning, shows the theme is gaining momentum. It's getting commitment. All right? Now, a couple of considerations, because we have had the S&P 500 bounce back up after that big pullback. All right? And we had the U.S. dollar starting to pull back. And of course, we're looking at the implications of risk in the FX world, like the yen crosses. Are they going to be able to pull back, or will they be forced to pull back, or can they just simply continue to appreciate? Because, yeah, you have something like an emerging or rising wedge on the dollar yen. Will it start to gain further traction? Will the euro yen and pound yen extend their advances? Will the Aussie yen and Kiwi yen continue their rally, or are they going to be forced to reverse? Right? When will the Euro USD move more on, risk off, rather than the back and forth of speculation related to the ECB and the Fed? Right? We have to see risk themes showing greater level of intensity before we can commit to those kind of risk-based moves. But something that I do want to point out, and I've actually spoken about before, is that these indexes are starting to come to some level of natural low. Now, I know that we can deflate a little bit further. This is the FX and equity volatility indexes. We can deflate a little bit further, all right? But if you look back out over the decades worth of volatility or VIX readings, I believe we have something over 15 years worth of VIX price action. We can also look at the FX version. And what we see is, at their current levels, they have what we call vols. So we are only about 2 vols, maybe 3, above the historical low in equities. We're only about 1 vol above the historical low on FX. All right? So you don't really have much more room to further deflate. What does that tell us? Well, it's going to be more difficult for a risk appetite rally, for those things that do benefit from an appetite for yield. If we have a further drop in volatility, that is a very big instigator of gains for something like the S&P 500. So the rapid rise we've had from this S&P 500 has a lot to do with the fact that we were erasing that risk premium that was there, that threat that the markets were going to drop off. And as that pulled back, the S&P 500 rallied. All right, very similar circumstance to the rally that we had or between September and October. Big rally as that threat diminished. But if we wanted to see the S&P 500 overtake 1900 and overtake 2000, that might be difficult to do, because historically we don't have much more threat premium to unwind. You really have to transition to something like really robust growth or high yields, which we know as fundamental factors are longer-term concerns. Right? They take a lot longer to develop, and these markets are simply going to struggle, given that we are already at record highs on something like the S&P 500. So what we're establishing here through a fundamental perspective is limited gain in terms of how far it can actually go, how quickly it can get there, versus very large risks, a reversal to the downside that can occur exceptionally rapidly. All right? That is something that we can see from these relative lows in presumed risk. Now, the U.S. dollar is going to be very much the opposite, because as a safe haven, if we have that risk of unwinding, of a big volatility, big risk rise, that's supportive of the U.S. dollar. So when we look at these relationships, the S&P 500, the yen crosses, the emerging markets, they will drop as risk aversion kicks in or volatility picks up. You can use the ATR once again as a alternative. But we have safe havens like the US dollar or like treasuries who improve their position as volatility picks up or risk picks up. All right? But you have to remember, volatility, as it's linked to risk trends are sometimes false starts. There is certainly a ebb and flow to risk themes, but if you want to see the big moves, the big trends, there's less likelihood of a big continuation of risk appetite. There is a greater risk or a greater probability of a really exceptional risk aversion move. All right? And you have to remember who benefits from risk aversion, who gets hit from risk aversion. And we measure that commitment in looking at these indexes or looking at the ATR, but we also look across the board. When that theme is influencing the entire market with momentum and under the same fundamental pretense, that's when we know we have a dedicated and remarkable move on our hands. All right? Hopefully that helps clarify the risk on, risk off theme, and when we know we have a true risk aversion drive, which I believe is probably inevitable at this point over the next couple of months. It just is a matter of timing, and this is the means to measure it. All right? We'll do our next strategy video tomorrow. Until then, good luck trading out there.